In the previous video, I audited the SuperTrend indicator. The goal of that audit was not to look at a few nice chart examples and decide whether the indicator is good or bad. The goal was to understand what the indicator is actually doing, how the signals are created, what the logic is based on, and where that logic can break down. And my conclusion was simple. SuperTrend is not a magic buy and sell system, but the concept itself is still interesting. SuperTrend gives us a clean way to define trend direction using volatility, mainly through ATR. It adjusts to market movement, it gives a clear directional state, and it can be useful as a foundation for a proper strategy if we test it correctly. So instead of stopping at the indicator audit, I decided to take the next step. I wanted to see what happens if we take the SuperTrend concept and turn it into something more testable, more mechanical, and more realistic. That is why I started building a custom MT5 expert advisor based on the SuperTrend idea.
Here is the full project flow. First, pre-register the strategy universe. This means defining all parameter combinations before selecting anything. For this test, the universe is around 1.2 million cells. A cell is one specific strategy configuration. For example, ATR period, ATR multiplier, stop loss, take profit, and any other rule included in the test. The point is simple. We define the search space first, then test it. We do not change the rules after seeing the results. Second, run walk-forward optimization. Instead of testing everything on one fixed period, the data is split into rolling windows. For this project, I use a 5-year period with 12 rolling windows. Each window has an in-sample section and a 6-month out-of-sample section. The in-sample section is where the strategy is ranked. The out-of-sample section checks whether the same setup still works after that period. This helps separate settings that only looked good historically from settings that keep behaving well across time. Third, select by stability. The candidates should not be selected by single highest profit result. That is usually how overfitting happens. The selected cells must pass predefined stability filters, such as appearing the top often enough in sample, be positive often enough out of sample, avoid terrible out of sample windows, and minimum average R per trade. And they need enough trades per window to make the result meaningful. So the goal is not the best looking backtest. The goal is stable behavior across multiple windows. Fourth, apply cohort-level multi-testing correction. This matters because we are testing a very large universe. When you test 1.2 million combinations, some will look good by random chance. So after selecting stable candidates, we check the selected group as a cohort. The goal is to estimate whether the results are likely meaningful or whether they are just the result of data mining. This is where PBO-style analysis comes in. Fifth, move the surviving presets into realistic execution validation. This is the MT5 EA stage. The script is used for research and selection. But the EA test checks whether those settings still hold when they are executed as an actual expert advisor. That means MT5 strategy tester, spread, stop-loss execution, take profit execution, trade management, and the real rules of the EA. This will be covered in the next video. Sixth, forward test anything that survives. If a preset passes the research stage and the MT5 EA validation stage, then it moves to forward testing on a real account. At that point, the question is no longer about historical results. The question is whether the strategy continues to hold in live market conditions. This means deploying the EA on a live trading account and evaluating the strategy after at least 100 trades. If it holds, then we keep the EA running and rerun the workflow after 4 to 6 months, or if any significant changes to any of the parameters or market regime is identified. Now let's break down each stage in more detail. Part 1 is pre-registering the universe. Before testing any SuperTrend settings, some parts of the experiment must stay fixed. These are not optimization parameters. They are the base conditions of the test. The instrument is gold, XAUUSD. The time frame is 5 minutes. The broker model is based on Pepperstone. The trading cost assumption is $17 round trip per lot. I also include a maximum slippage assumption of around 30 points. These values are fixed before the parameter search begins. They are not strategy parameters, and they are not selected because they are the best. They are simply the market conditions I chose for this project, according to my broker, and commissions that I will accept to be paying if I deploy anything to a live trading account. These assumptions must be included in the script. Otherwise, the results can become inflated. A strategy that looks profitable before costs may disappear after commissions, spread, and slippage are applied. So the script needs to test the idea under realistic cost assumptions from the beginning. Once the fixed test environment is locked, the next step is to define the strategy universe. This is the set of parameters that the script is allowed to test. Each unique combination of these parameters becomes one cell in the universe. The first parameter is the ATR period. The ATR period controls the volatility lookback used by SuperTrend. I test 7 values, from 5 up to 200. Lower values react faster to recent volatility changes. Higher values use a slower, smoother volatility estimate. The second parameter is the SuperTrend multiplier. This controls how far the SuperTrend band is placed from price, relative to ATR. A smaller multiplier creates a tighter band and usually allows faster direction changes. A larger multiplier creates a wider band and requires a larger move before the trend state changes. The third parameter is the signal source. I test 2 options: real OHLC candles and Heikin-Ashi candles. Real OHLC uses the actual market candles for the signal logic. Heikin-Ashi uses smoothed candles for the signal logic, which can reduce noise but also changes when signals appear. Note that this parameter only affects signal source and not trade execution. The fourth parameter is the signal price. I test either close or HL2. Close uses the candle closing price. HL2 uses the midpoint between the candle high and low. This changes the price reference used by the SuperTrend signal calculation. The fifth parameter is the trailing stop mode. I test 4 modes: off, 1 behind, TP touch, and bar close behind. Off means the initial stop does not trail. The other modes test different rules for moving the stop as the trade progresses. This allows the universe to compare fixed risk trades against trades where protection is adjusted after favorable movement. These modes are not extensive, but a good starting point for this experiment. The sixth parameter is the stop-loss multiplier. The stop-loss is measured in ATR multiples. I test values from 0.5 up to 5.0. A smaller stop reduces the allowed adverse movement, but can be hit more often. A larger stop gives the trade more room, but increases the initial risk distance. The seventh parameter group is TP1, TP2, and TP3. These are 3 take-profit levels, also measured in ATR multiples. That produces 48 valid take-profit structures. This lets the test compare different reward profiles without allowing logically invalid target sequences. The next parameter is the volume gate. This is not part of the original SuperTrend concept. I added it as an optional filter. The test either ignores volume or requires volume to be at least equal to its 20-period moving average. The purpose is to test whether excluding lower activity signals improves the strategy behavior. The next parameter is the higher time frame gate. This is also an added filter outside the original SuperTrend logic. I test the strategy with no higher time frame filter, or with directional filtering from the 1-hour, 4-hour, or daily time frame. The purpose is to test whether lower time frame gold signals behave differently when they are aligned with a broader trend context.
The final parameter is the ADX gate. Again, this is an added filter, not part of the original SuperTrend indicator. I test ADX as either off or filtered using thresholds of 15, 20, or 25. ADX measures trend strength, not direction. So this filter is testing whether SuperTrend signals perform differently when the market has a minimum level of directional movement. That is the complete parameter universe, and the size of that universe creates a serious statistical problem. We are not testing 10 settings. We are testing approximately 1.2 million strategy cells. This is where the deflated Sharpe ratio becomes important.
A normal Sharpe ratio is a good metric, but it does not account for the fact that we searched through more than 1 million alternatives before choosing the best-looking results. The deflated Sharpe ratio adjusts for that selection bias. It asks a harder question. After accounting for the size of the search, the length of the historical sample, and the shape of the returns, is the selected performance still statistically impressive? Under the conservative assumption that all 1.2 million cells are independent trials, the expected best Sharpe produced by luck alone is already around 4.9. That is the multiple testing wall. And within this experiment, with 5 years of data, clearing that standard will be extremely difficult. That does not mean the search is useless. It means that the 1.2 million cell search is not evidence of edge. The evidence only begins if a stable group of candidates can survive the statistical penalty created by that search. Now we've defined our universe. The next step is defining our walk-forward optimization. The purpose is to stop treating one historical backtest as proof of performance. Instead, the strategy is repeatedly selected on past data and then tested on the next unseen period. For this project, each window uses 24 months of in-sample data, followed by 3 months of out-of-sample data. The window then moves forward by 3 months, and the process repeats. Inside each in-sample window, the full parameter universe is tested. Only the top 1% of cells from that in-sample period are carried into the next out-of-sample window. The important point is that the out-of-sample result is not used to select those parameters. The settings are chosen first using the in-sample data. Then, their performance is measured on the following unseen 3-month period. I run this structure in 2 versions. The 5-year walk-forward test produces 12 out-of-sample windows, covering 36 months of unseen testing. This is the broader robustness test. It checks whether a configuration survives across a larger set of market conditions. The 3-year walk-forward test produces 4 out-of-sample windows, covering the most recent 12 months. This is the more recent regime test. It gives more weight to current gold behavior, but it also contains fewer windows, so the result has less statistical depth. The 2 tests have different jobs. The 3-year version is used to identify candidates that are relevant to the more recent market regime. The 5-year version is used as a robustness filter to reject candidates that only work in the latest period but fail across broader conditions. So the logic is not to choose between recent data and older data. Recent data is used for selection. Longer historical data is used as a veto. A preset becomes interesting only if it performs out of sample in the recent test and does not break down in the broader 5-year validation. To run this walk-forward process, I built a MQL5 script, which you can see on screen. This is not the expert advisor. Its job is to run the walk-forward optimization over the pre-registered parameter universe. For each rolling window, it tests the cells in sample, carries the selected cells into the next out-of-sample period, and exports the required results into CSV files. When it comes to the script, we need to note a few practical limitations. First, the data output is large. Across both walk-forward runs, the generated CSV files require around 36 gigabytes of disk space. Second, the computation is not quick.
Running the full process on my local machine takes around 15 hours. Third, some parameters require a warm-up period. For example, filters or calculations that need previous bars cannot produce valid signals immediately at the beginning of each test window. That means a small number of potential trades can be lost while the required data is being collected.
Finally, I am not running full tick-by-tick simulation at this research stage. Across millions of parameter evaluations and multiple rolling windows, that would be computationally too expensive. It is also not necessary for the purpose of this stage. The mode used here is logic refined. It infers the order of events inside the candle, so stops, targets, and signal outcomes can be handled more realistically than a basic bar close model. This is accurate enough for parameter research and walk-forward selection. The final surviving candidates will later be taken into MT5 expert advisor validation, where execution realism becomes the main focus. So now we run our script, and we have our CSVs that it generated. The next step is to move the data to Python for further evaluation. If anything survives our analysis, after that will be the EA strategy tester for execution calibration. However, all of that will have to wait until the next video.
Do you agree with our process? What would you do differently? Let us know in the comments. If you found this video informative, give it a thumbs up and subscribe to the channel. Thanks for watching, and I'll see you in the next one.